Hey everyone, Bill Lethman here for Money Evolution. In today's video, I'm going to be talking about how understanding your different types of taxable income could help you to more fully maximize your Roth conversions. Now, if you've been watching our channel here, you know that Roth conversions are one of our biggest topics. In fact, when we look at the number of views that we get across all of our videos, those Roth conversions up at the top of all of those lists. I think like a lot of people, myself included, I think a lot of us believe that tax rates in the future are going to go up. In fact, we know that these tax rates that are in effect right now, that were part of these Tax Cuts and Jobs Act rates from 2018, if nothing else happens, those rates are going to actually expire at the end of 2025, and we're going to revert back to the old tax rates, which are pretty much across the board a little bit higher in 2026. So in this video, we're going to get into maybe an area that's created a lot of confusion or some confusion for some of our clients, and really help you to understand the different types of income that you have and how that applies to you being able to do some of these Roth conversions. But real quick, before I get into today's video, if you want to learn more about what we're talking about here, you can check out the links below the video here and learn about our upcoming retirement planning course called the Retirement Time Machine, where we're going to be talking about Roth conversions, helping you plan for retirement, planning out retirement withdrawals, and a whole bunch of other topics. So check that out, or you can go to retirementtimemachine.com and get information there. All right, so let's jump right in. So what I'm going to be talking about here in today's video are going to be three different types of income as it relates to taxes. And understanding those different types of income is going to really be very meaningful in helping to understand how much money you can convert to a Roth IRA account. In other words, how much you can convert to a Roth IRA account without going up into that next tax bracket. So the three different types of income that we're going to be talking about are going to be your total income. And that's going to be basically everything that you're earning, whether it's from W-2, self-employment income, it's going to be dividends or capital gains. If you're in retirement, maybe you're taking withdrawals from retirement accounts. Basically everything that is going to be coming in, Social Security would be part of that, that number. And then the next one is going to be what's called taxable income, okay? And so what we know is that if you have a bunch of income, not all of that is going to be necessarily taxable income. For example, Social Security income, only up to 85% of your Social Security income is going to be subject to tax, okay? So that's not going to go 100% down to that taxable income number. If you're taking a standard deduction, for example, you're going to have some amount that's going to be taken off of your total income that's going to reduce that taxable amount. And then finally, we're going to talk about something called the base income. And what that is kind of making a distinction between that total taxable income and your base income and how much of that is actually hitting the income tax table. Because some things like long-term capital gains and qualified dividends are what I call preferential tax items, and those are going to be taxed differently outside of your income tax base tax table. Okay, so to kind of illustrate this, let's run through a little bit of a hypothetical example here. Let's assume that you're trying to maximize the 24% tax bracket. And you may have heard me talk about this in other videos, but if you look at the tax tables as they are right now under the Tax Cuts and Jobs Act rates, and you compare those to what the tax tables look like prior to 2018, one of the biggest expansions in that tax table, in my opinion, is that 24% tax bracket that really, in the case of a married filing joint couple, almost gave us about $100,000 of additional room in that bracket. So that's really where I think the sort of sweet spot is for most people. And so let's say we're trying to maximize that 24% tax bracket. So let's take a look at just to give you some numbers here real quick, we're going to compare our single individual versus a married filing joint individual. And so a couple of things there. For 2022, the top end of the single tax bracket for that is $170,050 for the married filing joint. Upper end of the 24% tax bracket. And for the married filing joint, it's going to be $340,100. And so basically, that's going to keep you in that 24% bracket. Additionally, we're going to have a standard deduction. So for single filers, it's going to be $12,950. And for married filing joint, that's going to be $25,900 as our standard deduction. And so again, you may be itemizing your deductions, and that may be a little bit higher than that, but we're just going to assume that you're doing that standard deduction for either single or married filing joint, depending on what your tax filing status is. Okay, so now let's look at a specific example here, and we're going to use the married filing joint tax status as our example. And again, we know that the upper end of the 24% tax bracket for 2022 is $340,100, and if we're taking a standard deduction, $25,900. And so if we simply add that together, that means we can have now up to $366,000 of taxable income and still basically be in that 24% tax bracket. So that's kind of lesson number one, is know that that standard deduction is actually going to increase the amount of room that you're going to actually have in that tax category. So now we're going to look at how different types of income are actually going to fill up that $366,000 tax bracket. And to do that, we're going to separate this into two individuals because I think there's going to be different components to each. One is going to be where somebody is still working, and we're going to talk about the different types of income and how it applies to that 366. And the other one is going to be somebody that's going to be in retired, because I think there's going to be some different components there and some different ways that that money is going to essentially be taxable. All right, so let's look at some numbers here. Let's say that you're working, maybe you and your spouse are both working, and we're just going to assume that you have maybe between you and your spouse a total of $250,000 of taxable income. Could be W-2 income, for example. And now we want to make a little bit of a distinction between maybe some different types of investment income. So we have short-term capital gains, for example, that are going to be applied to your taxable income base. And then we have things like qualified dividends and long-term capital gains, which are actually taxed a little bit differently and do not apply to that $366,000 income tax base here. So let's assume here, just for this example, that you have $5,000 of short-term capital gains, and so that brings your total obviously up to $255,000. And then we have some different types of deductions that we're going to have from this, okay? We've already taken out or taken into consideration your standard deduction, but if you're contributing money on a pre-tax basis to, let's say, a 401k or 403b plan or some other work-related employer-sponsored retirement, that again is going to reduce the amount of your taxable income there. If you do an HSA, again, that's going to also be reduced. We're not going to get into it too much here in today's video, but something to think about if you're really trying to get more money over to Roth, and we're talking about how much money you can convert to Roth, maybe if you're taking still pre-tax contributions to those retirement accounts, maybe that's something to think about changing up. And instead of doing the pre-tax contribution to the traditional 401k, maybe you change that up and do the Roth if that is an option through your employer-sponsored plan. All right, so let's assume that you are contributing money to an account on a pre-tax basis. So we'll say that maybe $40,000 per year between maybe you and your spouse, maybe that's going into a traditional 401k plan. Let's also assume that maybe you're doing $5,000 into an HSA. So we'll just label those real quick. 401k and HSA. So that's going to bring you down to $210,000 as the amount of income that you have that's still subject to tax. All right, now what we want to do is figure out how much money we have left in that bracket. So if we just very simply take the 266 and subtract 210,000, that lets us know that we have actually $156,000 in that bracket, where if you wanted to, or if you were inclined, you could actually do a Roth conversion up to that $256,000 without it impacting you into a higher tax bracket. So let's expand on this example just a little bit here. What if you had some long-term capital gains or you had some qualified dividends? Now remember, those are going to be taxed outside of your income tax base at what I call a tax preference rate. So again, $156,000 is how much you can convert and still be in that 24% tax bracket. Again, that's going to be at your income tax base rate. But let's say you had $20,000 worth of long-term capital gains, just as an example here. That's going to be taxed for this individual here at a 15% long-term capital gains tax bracket. And again, that bracket, which is the widest of all the long-term capital gains brackets, goes all the way up to $517,200 for married filing joint tax returns in 2022. If you go beyond that in total income, then you're going to be jumping up to the 20% tax bracket. Now, one other thing I do want to mention here as it relates to these long-term capital gains, we don't get into a whole lot of detail here, but if you do in fact do that maximum Roth conversion, now your total income, your total taxable income is going to be over the $250,000 limit for what's called the net investment income tax, which means essentially that for this individual, you're going to add on an additional 3.8% NIIT tax, which brings that up to 18.8% for that $20,000 of long-term capital gains. Real quick, one thing I want to mention here as it relates to that long-term capital gain or even the short-term capital gains or dividend income, one of the strategies that I like to talk a lot about to people is investing in a way with that non-retirement account bucket in a way that is going to hopefully limit drastically the amount of capital gains that are getting thrown off of maybe those funds or investments. In other words, things where you could control the capital gains. I mentioned it before, ETFs or exchange traded funds are a great way to do that in many cases where you have the ability to control that capital gain a little bit further here. So let's continue the example here. Now let's look at maybe some different types of income that are going to relate more to a retired individual and how that relates to these different income tax base and taxable income and so forth. All right, so now let's talk about a retired individual. Now there's going to be a few other moving components here that we need to take into consideration. So number one, if you're retired, you're going to have to figure out a way to get some money to meet all of your everyday living expenses, okay? And so depending on how your assets are structured, more than likely you'll have to take some withdrawals from some part of your portfolio. And that's going to have a difference on how this money is taxed and what kind of category that's going to fall into. So for example, we're not going to get into a whole lot of detail here, but let's say that you need $120,000 per year to live on just to cover all of your living expenses. It's going to make a big difference if you have, let's say, a whole bunch of money. Let's say you have $1 million in non-retirement account assets. Then essentially what you may be able to do is simply maybe take some money out of that non-retirement bucket. Maybe you have to sell some investments to do that, but you'll be able to fund that $120,000 for quite a few years there, basically, if you do the math on it, and depending on if there's any growth of that portfolio. If you don't have any money or you have very little money in non-retirement accounts, then basically what that's going to mean is a withdrawal from your 401k or from your IRA or one of your other retirement savings vehicles. Now, if you're taking it from a traditional retirement account, that $120,000 is going to be taxed as ordinary income. So we need to take that into consideration as well. And if you need that, let's say $120,000 to live off of, that's going to reduce, of course, the amount that you're going to be able to convert for a Roth IRA for that year. In addition, if you need to take $120,000 out of a retirement account, and that's the amount you actually need to live on, you are going to need to take out some bigger amount. Maybe that's going to be $150,000, $160,000, depending on what bracket you're falling into, that you're going to need to take out even more than that. And you're going to have a little bit smaller window to be able to take those distributions there. So just one quick piece of clarification that I wanted to make there, as it relates to where you're getting that money from. Now, the other kind of income that's a little bit unique, obviously, to people that are retired is going to be Social Security income. Now, one thing there is that not all of your Social Security income are going to be subject to tax. So, for example, if, let's say, between maybe you and your spouse, you have $60,000 per year of Social Security income, only up to 85% of that is going to be subject to tax. So we just multiply that by 0.85. And that works out to be $51,000 would actually be subject to income taxes. So when we start to figure out, okay, we've got that $366,000 that is the total income, including our standard deduction, where we can still be in that 24% bracket. Now, if we have, let's say, that $60,000 of Social Security income, we're not going to reduce it by the full $60,000, only the $51,000 that's going to be our taxable portion. So what we're really trying to do here is help you to really figure out how to squeak every last drop out of that Roth conversion to get all the way up to the maximum amount of the tax bracket. And a couple of these things that we're sharing with you today are things that a lot of times are overlooked because people may not necessarily understand all of the different moving pieces and how they interrelate to one another. Okay, so let's run through a couple hypothetical examples here. So let's take one example where it may be somebody that does have that large non-retirement account balance. Okay, so they've got, let's say, $1 million in various assets. They could be stocks, they could be mutual funds or ETFs and everything. And so again, remember, you need $120,000 for your living expenses. And we'll assume that, let's say you have $120,000 in some stocks or some mutual funds. Now, if you sold all of that, not all of that $120,000 is likely to be taxable, okay? Because if you bought it at a certain price, you have what's known as your cost basis, okay? So you may have, let's say, $120,000 worth of stocks, and maybe the cost basis on that is $100,000, meaning that you're only going to have to pay taxes on $20,000, which is your capital gain on that. And hopefully it's a long-term capital gain, and that's something you want to pay attention to as well, is hopefully sell things that you're going to incur a long-term capital gain, because that's going to be at that preference rate as opposed to your ordinary income tax rate, and then further adding to the tax base. You may have $120,000 worth of securities that maybe have a $60,000 cost basis. So you have $60,000, but it'll most likely be something less than that full $120,000. So let's take an example here. Let's say you do, let's say you have a $100,000 cost basis there. So you basically are going to have $20,000. And again, hopefully that's going to be a long-term capital gain. So once again, that's not something that's going to be reducing the amount that we have eligible in that bracket, but rather it's going to be taxed on a separate line item than your income tax base. So we're still going to have that full $366,000 available to us. So let's work through continuing the numbers there. Let's say that you have that $51,000 of Social Security that's going to be taxable. I should have moved this to a different spot. In fact, maybe I will just do that. I can move that down there, and we'll move this up there. So that would be $315,000 after we subtract that, and that would be the amount essentially that would be left in that tax bracket going up to $366,000 with our standard deduction added in there as well. And then to kind of finish that out, that $20,000 long-term capital gain, again, because we're doing that large conversion, that's going to push our total taxable income over the $250 mark. So that means that we're going to get hit with that net investment income tax of 3.8%, bringing our long-term capital gains rate up to 18.8%. So that would be another, $3,760 in tax. Now we're just talking about federal taxes here. Of course, whatever state you may be in, if you're in a state that does have income tax, you're going to have to figure that out and kind of run through these numbers with that in mind as well. But we're just really talking about the federal taxation here on this. Okay, so now one of the questions I get asked all the time is, does it still make sense to do these Roth conversions if I don't have any money in a non-retirement account? In other words, if in retirement I not only have to take some money out for my living expenses out of a, let's say, a traditional retirement account like an IRA or 401k plan, but in addition to that, I need to take the tax money out on the conversion from the IRA account itself. So to kind of answer that question really in very simple terms, we've talked about it a lot in other videos, is very simply, is my tax bracket today higher or lower than where I think it's going to be in the future? So if we think our tax bracket today, let's say that 24% bracket, like I said, is really sort of the sweet spot of the current tax code. If we think that's going to be a 28% or even a 32 or 33% or higher down the road, then it's going to make sense for us to pay the taxes today at that 24% rate instead of paying taxes later at the 28%. And I've had other videos where I get into that a lot more extensively here. But let's take a look at an example and see what that looks like. So again, adding in our standard deduction, we're targeting $366,000 of total income, total taxable income at our tax base. And let's assume that we have no other money to take from. So we don't have a huge pile of investments that are in a non-retirement account where we can sell that, maybe get some of those long-term capital gains. But let's say all of our money pretty much is in that traditional retirement account. And what does that look like? Okay, so let's assume still that you need that $120,000 per year just for your living expenses, or $10,000 a month, however you want to look at that. And again, we're going to target this $366,000. So if we said, okay, we're going to totally maximize that $366,000 tax bracket, if we just simply multiply 366 by 0.24, that's going to tell us the total amount of taxes that we're going to have, and it's going to work out to be $87,840. Okay, so now what we need to do is we know that that $87,840, I should have wrote it over here, that's going to actually get added to your 120 that you need, and that's going to be how much your total withdrawal is going to need to be from the retirement account. So that works out to be $207,840. Okay, and so that's what's going to come out of the IRA for your living expenses to cover that 120. to cover the taxes on the living expenses and also cover the taxes on the amount that we're going to convert for the Roth. And now to kind of finish this out here, all we're going to do is take that 366, subtract 207, and so that means we got $158,160 left to convert to our Roth IRA. And so this may seem like a little bit easier scenario, and it really kind of is, because with the non-retirement accounts we have a lot more moving pieces, but this is the really simple math of trying to figure out how much your maximum Roth conversion is going to be on an annual basis. All right, so there you have it. So if we kind of shrink this all down, you can see all the stuff we went through there. Lots of detail, lots of math here, but hopefully you're going to walk away from this video with at least a lot better understanding of how some of those different forms of income are going to be taxed. And once again, if this is something you want to take a much deeper dive on, we're going to have our upcoming retirement planning course called the Retirement Time Machine. And I actually have very detailed worksheets that I kind of outline all of this, where you just basically fill numbers in, do some of the simple math here that we walked through in this video, where you can see kind of year to year how much money you should be converting to a Roth IRA account, how your income is going to be taxed in different years, even while you're working, and also how that translates into your retirement years. So again, if you want to learn more about the upcoming course, you can go to retirementtimemachine.com, click on one of the links below this video, and hopefully we'll get a chance to see you there in our upcoming course. Have a great day, and we'll see you in our next video.